Here's a number that stopped a lot of Brisbane investors in their tracks. According to the latest CoreLogic data from May 2026, Brisbane's median dwelling value is now sitting at $1,116,180, up nearly 20% in just 1 year. Rents are climbing, vacancy rates are at a near-record low of 0.8%. On paper, this looks like the best market in the country right now. But here's what the headline numbers aren't telling you. Underneath all that growth, there's a tax situation quietly eating into investor returns, specifically for people holding multifamily properties like duplexes, unit blocks, and small apartment complexes. And it's not just one policy. It's a combination of state-level land tax changes that have been stacking up since 2024, plus a brand-new federal budget dropped just last month that's reshaping the entire investment landscape. So if you own a multifamily property in Brisbane or you're thinking about buying one, this video is going to break down exactly what's changed, what it means for your numbers, and where things are headed. Let's get into it.
First, let's talk about how Queensland land tax actually works, because a lot of people get confused here. Land tax is an annual charge the state government applies to investment properties you own in Queensland. It's not stamp duty. That's the one-time fee you pay when you buy. Land tax is every single year, assessed on June 30th, based on what the government calls the unimproved value of your land. Basically, the value of the land itself, not the building on top of it. Now here's the part that trips up a lot of investors holding duplexes or unit blocks through a company or trust structure. If you're an individual, the tax-free threshold is $600,000 in Queensland, meaning if your land is worth less than that, you pay nothing. But if you're holding the property through a company or a family trust, which is how the majority of multifamily investors structure their ownership, that threshold drops all the way down to $350,000. And in Brisbane right now, $350,000 in land value is not hard to hit, not even close. In April 2026, Brisbane houses hit a median of $1,222,906. Units hit $876,474. The land component underneath many inner and middle ring Brisbane investment properties has already cleared that $350,000 threshold on its own, which means the moment you hold through a trust or company and you're above $350,000 in land value, you're paying land tax from the first dollar. Above the threshold, rates start at around 1% and climb progressively up to 2.25% for large portfolios. For companies and trusts, the Queensland Revenue Office applies higher marginal rates at each bracket compared to individual owners. So right out of the gate, the way most multifamily properties are held means more tax exposure than a single investor-owned house.
Now let's get to the big shift that hit in July 2024, because this is where things really moved. On June 11, 2024, Queensland Treasurer Cameron Dick handed down the state budget, and inside that budget were two changes that hit multifamily and foreign investors hard. Number one, the additional foreign acquirer duty. The upfront tax paid when a foreign entity buys a property in Queensland jumped from 7% to 8%. That's the tax you pay at the door before you even own the asset. Number two, the annual foreign land tax surcharge, the extra tax charged each year on top of standard land tax for foreign companies and trusts, rose from 2% to 3%. According to the Queensland Revenue Office's own published calculations, that 3% surcharge applies on every dollar of taxable land value above $350,000. So take a foreign-owned company holding a Brisbane duplex with land valued at $700,000. That entity pays standard land tax on the full amount, plus a 3% surcharge on the $350,000 above the threshold. That's an extra $10,500 per year just from the surcharge alone, on top of whatever the base land tax bill comes to. The Queensland government estimated these two measures together would generate around $420 million in additional tax revenue over 4 years. And that money, as the saying goes, has to come from somewhere. The Real Estate Institute of Queensland pushed back immediately, REIQ CEO Antonia Mercarella had been warning about this for years. She called the surcharges a deterrent for capital coming into Queensland, and with about 36% of Queenslanders living in rental accommodation, pulling investment out of the market at a time of record low vacancy doesn't help renters. It does the opposite. But the surcharges went ahead anyway. By the way, if you're finding this useful, hit subscribe and turn on notifications. We break down exactly what's happening in the Australian property market every single week with real data, no fluff. The bell is right there.
To understand where we are now, you need to know what happened a couple of years earlier, because Queensland has been down this road before. Back in 2022, the then Palaszczuk government announced something that caused a near panic in the investment community. The plan was to calculate Queensland land tax using the total value of all investment property a person held anywhere in Australia, not just what they owned in Queensland. So if you had a duplex in Brisbane worth $700,000 and a rental unit in Sydney worth $800,000, Queensland wanted to combine those two, look at your $1.5 million total Australian landholding, figure out which tax bracket that puts you in, and then apply that higher rate to your Queensland property. The example the government itself used showed an investor who previously paid $1,950 per year in land tax suddenly facing a bill of over $8,400, more than 4 times higher, without buying a single new property. The response was swift, and it was ugly. A survey by the Real Estate Institute of Queensland of over 3,300 Queensland property investors found more than 80% of landlords were considering exiting the market over that and related tenancy law changes. Research from MCG Quantity Surveyors found investors fled the market in droves during the 98-day window between when the policy was announced and when it was scrapped. One industry report described the damage as irreparable. Investors left, rental stock tightened, and it accelerated the rental crisis Queensland was already in. The government eventually scrapped the interstate aggregation plan entirely. REIQ CEO Antonia Mercarella said, and I'm paraphrasing here, abandoning that tax regime was the right call, because sending shockwaves through the private housing investment market during a rental crisis was unprecedented and illogical. But, and this is the key, what that episode showed was exactly how sensitive Brisbane's multifamily investment market is to tax changes. When the numbers stop working, capital moves fast.
Now fast forward to May 12, 2026, federal budget night. The Albanese government dropped 2 major property tax reforms that sent investor sentiment into a fresh round of uncertainty, and Brisbane's multifamily market is right in the crosshairs. Reform number 1. Negative gearing for established residential properties is being abolished from 1 July 2027, but only for properties purchased after 7:30 p.m. AEST on 12 May 2026. If you already own something before that cutoff, you're protected by a grandfathering clause. If you bought after, or if you're buying now, negative gearing on established properties goes away next year. For multifamily investors who are using rental losses to offset salary income, that's a significant change to the cash flow equation. Reform number 2. The 50% capital gains tax discount for individuals and trusts is being replaced with cost-basis indexation and a 30% minimum tax rate from 1 July 2027. New builds are exempt from both changes. The government's stated goal is to push investment toward new housing supply rather than established stock. But here's the irony. Most duplexes in existing unit blocks in Brisbane are established properties. They're the ones that just lost those tax incentives for new buyers. According to Commonwealth Bank's updated housing outlook published in May 2026, these changes are expected to moderate Brisbane's dwelling price growth forecast from 5% down to 3% through to December 2026. That's not a crash, but it's a meaningful repricing of what these assets are worth to a buyer who can no longer rely on the same tax treatment. As of May 2026, analysts at Real Estate Business noted that Brisbane's property market had reached a genuine inflection point, values still rising, but sentiment turning more cautious. The auction clearance rate recently came in at 48.8%, with buyers pushing back on vendor price expectations. That's not what a hot market looks like.
So put all of this together, and here's where things stand as of June 2026. If you own a duplex or small unit block in Brisbane through a company or trust, you're almost certainly above the $350,000 land tax threshold already. You're paying annual land tax at higher marginal rates than an individual owner. If that structure is classified as a foreign entity, you're also paying the 3% surcharge on top. Meanwhile, gross rental yields in Brisbane are sitting at 3.1% for houses and 3.9% for units, according to real estate business data from May 2026. Those yields sound okay in isolation, but net yields after land tax, property management fees, insurance, rates, body corporate fees, and now higher mortgage costs with the RBA cash rate at 4.35%, those net numbers are tight. For some multifamily investors, they're negative, and the buyer pool for these properties has shrunk. Anyone purchasing an established multifamily property today loses negative gearing access from July 2027. Foreign entities face an 8% upfront duty plus the annual surcharge. The number of buyers who can make the numbers work has genuinely decreased. Queensland's dwelling approvals tell the same story from a different angle. Supply is not keeping up. Approvals spiked 34.2% in November 2025, then fell 16.3% in December, then another 6% in January 2026. The trend is essentially flat, well below what Brisbane's population growth demands. Builder insolvencies, labor shortages, and construction costs are all contributing. CBRE forecasts just 3,100 new inner-city dwellings per year from 2026 to 2031, against demand of roughly 16,000 per year. That gap isn't closing. What that means is the demand story for rental housing in Brisbane is not going away, but the investor willing to supply that rental housing is being squeezed from multiple directions at once. State land tax, federal budget changes, higher rates, and tighter yields. Some of those investors are doing the math and deciding to sell. And when they sell to an owner-occupier instead of another investor, that rental property disappears from the market. It's not dramatic, it's gradual, but it's happening.
Here's the bottom line heading into the second half of 2026. Brisbane's property market is genuinely one of the strongest in the country by fundamentals. Population growth, tight supply, low vacancy at 0.8%, rents rising 6.7% year-on-year, none of that has changed. ANZ Research is still forecasting close to 10% dwelling price growth for Brisbane in 2026. But for multifamily investors specifically, the people holding duplexes, small apartment blocks, unit complexes, the holding cost environment has changed significantly. The Queensland land tax surcharge increases from 2024, the new federal budget restrictions on negative gearing from 2027, the change to capital gains tax treatment, and the higher rate environment are all landing at the same time. The properties themselves aren't becoming less valuable. The cost of owning them as an investor just went up considerably, and when that happens, what buyers are prepared to pay for those properties comes down. Everyone in this market, investors, renters, first home buyers, is watching what happens next, because the decisions being made right now on tax policy are going to shape how much rental housing exists in Brisbane for years to come. That's the story, and it's one that's still developing.